So a few days back, my wife told me that Ugadi is coming in 3 days. So let's buy fruits and flowers now only, right? So because during that Ugadi time, the price may shoot up. And I was like, yeah, that makes sense. But then she hit me with, why don't you do the same with other things? Why not buy your clothes or anything you need early before Diwali or whatever function or your birthday instead of waiting till the last minute when the price goes up. Now that got me thinking. We all cannot do this, right? So we wait till everyone else is buying, and by then prices have already shot up. It's just how demand and supply works. And guess what? Investing works the exact same way. If you understand how the economy moves, just like how festivals or seasons affect prices, you can invest in the right sectors at the right time. And that's what we are going to break down today. How to ride the economic wave using sector investing. This is Sundar and you are watching Mindful Finance. So think of the economy like the seasons. You wouldn't wear a winter jacket in summer, right? The same logic applies to investing. You don't want to put your money in the wrong sector at the wrong time. The economy moves in 4 phases. And in each phase, different sectors do well. If you get this right, and you can seriously level up your investment game. All right, let's go phase by phase. The first phase, which is expansion phase. So the first phase is expansion phase. The second one is peak, and third is recession, and fourth is recovery. You can see like this. Okay, this is a hypothetical, theoretical way of representing. Normally, it starts with the phase one will be like expansion, and then the peak, it reaches the peak, and then it falls, which is called trough, and the fourth phase is recovery phase. So when you identify this each phase, and you can be prepared for what is the next phase is going to be, and what sector is optimal for that phase, and you can invest in those sectors so that you can gain a good profit. And also this has to be done in a periodic way so that you can rebalance this. Once in six months, you have to rebalance this. So let's get a deep dive. The first phase, early expansion phase. So this is when things are looking good, businesses are hiring, people are making money, and spending is on. Everyone's feeling secure. And when that happens, we start spending more. That's just the wealth effect. You know, when people feel richer, they tend to spend more, even if nothing major has changed in the actual income. So companies are expanding, borrowing money, and investing in new projects. People start buying cars, upgrading their phones, traveling. So you get the idea, right? And that's why certain sectors shine during this phase. So basically, where you need to invest in this time? You need to invest in more in banking sectors where people start to get more loans. The banks make more profits from the loans. Then consumer discretionary, like people buying non-essentials, luxury goods, and they travel, shopping, and auto sectors like car sales pick up big time. So if you are looking for investment during this phase, look for banking funds, auto sector funds like that. So next phase is mid-expansion phase. So now the economy is firing on all cylinders. This is when businesses are making serious money. Stock markets are going like crazy. And everyone thinks that good times will last forever. Optimism bias, meaning people start believing things will always be this good, but it won't. But for now, like, let's assume things are solid and things are good. So what happens? Governments are spending on infrastructure, new startups are popping up, and tech is booming. Everyone is going all in all growth. So now where to invest? Technology. So for example, now it's AI, fintech, automation kind of a thing, all those cool stuff. The second sectors would be industrial and capital goods like factories, construction. Then the infrastructure like roads, bridges. The government spending increases here. So focus on the funds which are like tech-related funds, infrastructure funds, all those kind of a thing during this phase. Because every company and sector has the access for capital because bank is giving loan, right? Money is printed more at this point of time. So liquidity is more driven the market. So this is more of a fun phase, right? The third one, which is peak phase. So this is kind of a phase like it's kind of warning bells, okay? But now we hit the peak, and you know what happens when something is at its peak, right? That's only one way. Yes, it has to go down. Inflation is getting crazy high. Everything is expensive, and central bank starts to increasing the interest rates and borrowing money. Forget about it. It's too costly now. Business starts feeling the pressure. Profit margin shrinks. Stock market gets volatile, and some sectors start struggling. But here is the trick: smart investors don't panic at this point of time. They'll try to rotate the sectors. So where money goes here, you have to focus on gold and commodities. Because when inflation is high, people rush to the gold. Healthcare and pharma, because it's a defensive sectors, people always need medicine no matter what. Then the utility and companies like water, electricity, internet, people won't stop using them. These are like a defensive thing. So best mutual fund to buy during this time: gold funds, pharma funds, utility funds, right? These are the best time for that one. But why defensive sectors at this point of time? It's the word itself very clear, right? It's a defensive sectors because whatever happens during this phase, these are the companies always thrive, right? You will not stop buying rice, you will not stop buying oil, you will not stop buying toothpaste, you will not stop buying dress, right? Dress at least okay means if it's not a regular thing, I can wear one or two dress for the entire year. But food, right? Whatever consumer related stuff, you will end up in buying. So those are the things called as defensive sectors because this time people will not think about buying expensive stuff. They want to reduce buying, but the daily life has to run. For that, they have to focus on this one. The next phase is recession phase, where the slowdown happens, right? And this is these things get real. Businesses start laying off employees, job losses rise, people cut down on spending because well nobody wants to splurge when they are unsure about the future. Now you see how completely it's reversed, and this is where concept called loss aversion kicks in. People are more scared of losing money than they are excited about making money. So they panic. The panic selling will happen. But here is the thing, right? This is actually the best time to start preparing for the next cycle. So as I mentioned, here also during this recession time, you have to focus on defensive stocks like consumer staples, right? Soap, daily essentials, then the health and pharma, right? So these are like recession proof. Then dividend yield stocks, stable companies that keep paying dividends even in tough time. So focus on the funds which are like FMCG funds, dividend yield funds, etc. Now comes the last phase, which is recovery phase, which is again like a first phase. It follows the first phase. Then the cycle restarts. After every storm, there's always a calm, right? So businesses slowly start hiring again. Demand picks up and people regain confidence. But here is the problem. Most investors are still scared. This is called recency bias. Because things were bad recently, people assume they will stay bad. But history has shown that markets always recover. And this is actually the best time to start buying again. So during this time again, you have to focus on consumer discretionary, banking, and mid and small cap funds, right? Because you need to take more risk at this point of time because it is going to again, the next cycle is going to start, which is a bullish market. So just to explain the realistic scenario with an example, if you remember this one, during the post-COVID recovery, which is 2021, what happened? Tech and pharma stocks went like crazy, right? Everybody were betting on the pharma stocks because everybody working from home. So technology stocks are doing good, right? Because they are working from home. Infosys, TCS, they recovered very fast. Pharma sectors were very fast because but whenever this kind of panic happens, pharma will go. Without medicine, we cannot run anything, right? And the second phase, if we say 2022 to 23, which is high inflation phase. So this is time when gold and commodity prices increases, right? During the COVID price, even the crude oil prices went in negative, right? And during the phase, now everything has started back, travel, tourism, everything kicked back, infrastructure started to gain more, house rentals are started to grow high, right? So people started to buy gold more because they faced the problem earlier, right? Now they should, since they faced the problem earlier, now they wanted to be sure that next time if anything happens, they should be secured. So they will focus for gold and commodities. Then third phase, 23 to 24, what happened? So recession started to be fear, like now people start to feel fear at that time, like now the market was falling, right? So what sectors were going good now? All the FMCGs will pick up now. Pharma will pick up. So you see the pattern? The cycle keeps repeating. If you invest before the crowd moves in, you get in all the best prices and make the most gains. So yeah, so investing is not just about picking stocks randomly. It's about knowing when to invest in which sector. That's what smart money does. So there's a saying that more than timing the market, time in the market. That's perfectly correct. I need to be in the market, but in the market, what I need to do that nobody tells you, right? I'm okay to be in the market, but what I need to do the market in the market, which sector I need to choose, which sector is falling like a crazy, which sector is bottomed out, or what is the next step. So further, you need to know the macroeconomics. You need to keep watching the details regularly. I know this. So this is exactly explained in the Elliott Wave Theory, but I'll cover the Elliott Wave in a separate video. This itself will take a separate video. But mostly, whatever the cycle which I said, you can capture that in Elliott Wave. So for this, what you need to do basically, right? You need to monitor the economical indicators. What is happening in the market currently? So you need to understand whether bank loans or interest rates are what they are currently. You can understand that. Based on that, you can find out which phase you are, right? The recession phase, interest rates are not going down till now, right? So still you cannot feel the market isn't coming to a bullish mode. When everything is good, then the interest rate will be reduced. Companies, businesses will start to get more loans so that they will hire more people. Now, hiring is not there because to increase the operating profit, they will cut down the employees' cost. They'll fire people, or they will reduce the salary of the people, or they will not increase the salary of the people. That is how they can increase their profit. That is gross profit, right? Because that's how they can show the growth of the company. Otherwise, the company growth will be shown in negative. So people will feel the pressure and they'll start to sell the stock, right? So this is how happens in every sector. Every company prepares themselves for handling this kind of things, and you have to make sure to rebalance your portfolio based on like 6 to 12 months regularly. So that's it. So smart investors normally they'll be very careful, and if they when you invest in that way, you will be normally outperform the others by at least by 11%. It is a proven record, right? If you have a clear understanding of these four phases, I'll show. I'll touch upon that one. Let me show you that one for you guys. If you see this, I have marked down for you guys so you can read it properly. Okay, this is the Elliott wave property. Okay, you see the waves. Okay, so this is the first wave. So everybody were good and feeling happy. Market goes down, everything is good, right? This is the recovery phase from the fall. Everything is good, but still people are feeling bad. Like till it goes here, right? They are worried whether market still going up or not. So they'll have doubt. That is where the market goes down. Okay, they'll book a profit. They'll try to be cautious. But again, this is the next phase. Interest rates are reduced. Companies are doing good. Infrastructure is building a wealth. Right, coming new projects are coming up. Lot of people are hired. Lot of people start to buy home. So this is the phase. It's a thrives. Market thrives, and then again profit booking happens. People try to be very cautious, and next phase would be your panic phase. This will be a very high growth phase. Consider to all this thing, this is a very high growth phase, and which is what we are expecting to happen, but not now. This phase still will be a consolidating phase, but this is the time we need to invest more because this is the consolidation phase. The base is setting up here, and then when it goes right, the recover. Like what happened here, people were panicked whether the market will go up or not. They'll have doubt, right? That's what happened. So when they enter, again, see when you would have entered here. Now it fell down to what you invested during this phase. Whatever investment you faced, that is corrected here. You get panic. You start to sell everything. Again, market goes up. Market goes up. So again, you get panic here, right? Now everybody is panicked now, selling it. And during this phase, commodity prices are going up, right? Commodity prices, the gold price skyrocketing now, right? So this is what exactly how Elliott wave works. Elliott theory is like behavioral pattern. It gives the psychology of the current trend. You can understand this if you know how to plot the Elliott wave. You know the psychology of the market now. So I'll take this as a separate video. Post in a comment if you want that video. Okay. So this is what I wanted to cover in this video. So hope you got the idea. whenever you're talking about the sectoral kind of a funds, I have given a hint about what kind of a sector you have to focus on which phase. But that further, you need to understand the macroeconomic. It's very risky thing. Okay, if you don't know how to find out the sector, you may misled. You may gone wrong. You might get panic when you should not be panicked. Right? That is the thing. So the whole thing is keep learning, keep on understanding the market. So hope you like the video. If you like it, give a thumbs up, put your comment, share it with your friends and family so that it reaches to more people. And don't forget to press the notification icon so that it reaches you on time. Thank you.